If you go back and read our earnings in Q2, we grew the company as a whole 40% year over year on revenues, and we expanded margins because of the content that we bring into that revenue now has a bigger mix of networking, software, and cloud services. And in that context, we believe networking is going to be the thesis of our company. If you think about developing these frontier models, whether proprietary or open source models, you need a lot of GPU power, but that GPU needs to be very productive. You don't want to keep it idle. And the bottleneck of that is networking. And so we have now, with the acquisition of Juniper, an amazing portfolio in the three key elements: scale up, scale out, and scale across, which position us to be a core element of that infrastructure build out. So this is why we believe the company is going to grow double digits going forward and will continue to expand operating margins. And that will translate in free cash flow. So we already guided, which is unlikely, and in many cases, for 6 quarters ahead. So think about it, because of the confidence we have in our growth trajectory.
Antonio, where do you think this technology, this AI technology story is? I mean, a lot of folks are saying we're still in the very, very early innings, but you just think about the amount of CapEx that is being spent by a variety of players within the substack. It's just extraordinary. Where do you think we are in that compendium there of AI investment?
I concur with that. We're still early. And Paul, what you have to understand, there is 3 customer segments you have to look into it. Number one is the model builders and the hyperscalers and the neocloud. We're building large amount of compute capacity. We believe by the end of the decade, we're going to build 250 gigawatt of power that will host these GPUs. And that's the capacity you're talking about it. But then ultimately, what is the mix of that capacity? It's going to be shifting from training models to inferencing models. And that's where we're going to see the large adoption of AI into the enterprise to drive that productivity. But if you put it in context of industrial revolutions in the past, this actually is very small compared to that spend that was done in every inflection point, including the turn of the past century. So yes, I understand the concern about the amount of CapEx, but when you put it in context of changing the way we work, the change in our society, we're still small relative to that.
Just looking at how you might be deploying cash, I know that you tapped the debt market in March to refinance some upcoming maturities. You've got strong liquidity with cash and equivalents of more than $5 billion at the end of the second quarter. What might prompt you to go to the debt market again to raise more money?
Well, we do that very regularly because, remember, inside HPE, we have an operating company. Obviously, we are paying down the debt and refinancing where we need to. And that's the operating balance sheet you're referring to. So our balance sheet is super, super strong. And then we have the financing company, which has $13 billion under asset management. Think about the financing we do for customers. And we do it also as a part of the asset lifecycle management services. And basically, we have debt securitized against those assets, but the return on equity on that is super high, super, super high. So we use those vehicles when it's necessary. But what we announced just at the beginning of this month in our earnings is that we're going to pay down that debt much faster. In fact, we expect to return to 2 times leverage by the end of this fiscal year, which is 1 year ahead of plan. And we're going to start returning 75% approximately of our free cash flow in 2027 to shareholders, which we expect to generate at least $4.5 billion in dividends and share buybacks. That's how we're going to return it. So we are very strong. And that goes back to the question you asked me before, where it comes from, the growth and the operating margins.